is visible, right? Once again, good evening to all of you, and I thank IACC for giving me this opportunity to share some of my thoughts on reverse due diligence. Before getting into subject, let me set a little bit of context, and I also want to congratulate the ISRO community for the fantastic feat they have done in landing Chandrayaan-3 on the moon. We have been celebrating, and I think we're all still in the celebration mood. I think as an Indian, I think it's a very, very proud moment for all of us. If you see, last couple of months, several news headlines, right? A lot of buoyancy is around, India as a country, economy, several headlines are hitting towards the positiveness. There are incidents, some of the, issues, as country we face, as citizens we face, but, at a macro level, I think, the direction is, very, very positive and, very, very positive buoyancy, which is there around. I just wanted to share a couple of things with, before we get into the topic. Yesterday only we got the first quarter GDP numbers. It is talking about 7.8%, Q1 GDP. And FY23, we had 7.2% GDP. I think no other country can boast of, this kind of a growth. Several developed countries are going through recession or a negative growth or zero growth, but we are at 7% growth. That's a fantastic situation. And then we've been from 2014 to 2024. That's the numbers everybody is talking in the current government. We moved from a 10th position. As a economy, we are at a 5th position. We are close to $3 billion economy. 2030, we are likely to become 10 trillion economy. 2047, we are thinking about becoming a developed nation. And several data points. I am just taking a few data points, which we have been going through every day. Middle income population is again growing, which is talking about the consumption, the whose consumption India is likely to consume, which is going to offer huge opportunity for businesses and services. 2 days back, we have numbers from the income tax departments. For last few years, how the incomes have changed. The lower and middle income group and all of that. The income was around 4 lakhs in 2014, and now it has moved to 9 lakhs. There are several pointers like this which are giving very, very, very positive sentiment for all of us. As a professional, running the professional services firm, working with the several businesses, it gives me personally and also firms like us huge opportunity. We are here for a long haul, as a business and country. I think next 20-30 years, it is the India's I think journey. I think everybody all over the world, any business, anybody in the business as a significant player, he wanted to grow. I think he or she, whatever, that business has to come into India. That's where you cannot afford to ignore India in your scheme of things. Given either you will be coming for 2 reasons. Either one for the consumption, which is very huge. We have India, we have Bharat. Within India, we have several economies within. Even if you again see several data points on the premium segment products, high-end cars, luxury products, it is growing. Every segment we are growing. So from a consumption perspective, we are going to grow. One. Second, talent perspective. Any business in the world, they look for these two. Either of them or both of them. Either where do I get my customer and so that I can expand the market. Second, I need to get the talent. Where do I get this talent? These two are available in India, and which is maybe for next 20-30 years. I think that way we are in a fantastic position. I'm thrilled. Several times I keep telling myself the amazing changes which we are witnessing. What we saw maybe last 20-30 years is one part of it. I think same thing maybe at a lot more faster pace we may be able to witness in next 2 to 3 decades. Technology, I don't think we need to talk about it. So in terms of the chat GPT, AI and all of that, the way these things are impacting each one of us in many ways. It could be your individual life, family life, spiritual life, and professional life, in the business. Nothing is untouched. Everywhere there is a tech is playing its own significant role. Therefore, adapting and moving with the tech, is very, very important. This is one general high level context I wanted to set and also appreciate where we are. I mean, this topic, last, year or so, we have been working on, few transactions, and, my experience, and thanks Avinash for a very, very detailed introduction. My experience of last 25 years has been working with several mid-sized and growing companies, work with sort of startups, mid-sized companies, SMBs, growing companies. I've seen several transactions, lot of work we have done, individually, but we have also worked with several promoters and companies in the transaction. I mean, obviously, a lot of these companies, you have a scarce in terms of resources. Resources could be your time, the resources could be money. You always have scarce of capital and the time when you are early stage in your business growth, early or mid segment kind of a thing. But when the transactions happen, when you are moving from one orbit to the next orbit, that's where some of these corrections are, alignment needs to be done. If you don't do in the right time, the cost of not doing will haunt you. It will become a big stumbling block as you grow in your business, in the corporate development. I mean, we will see some of those things as I go through my presentation. I mean, I have few slides, but not necessarily I will go through line by line. I wanted to speak what is relevant, and some of these slides also I skip. But at the end, I'm happy to take few questions and see how can I address your specific questions. In the context of reverse due diligence, if you look at the context, for everything today we have review, rating, feedback. That is the world we are in. If you are having a cab, going to a restaurant, going for a movie, at least in the B2C, in the consumption, whatever we consume, it has become very, very, we are all depending on rating, review, and feedback. The same thing is going to go, so the same thing is going to come into the, even in the business in a big way. I mean, we will see how that is, getting unfolded. In terms of context, from a regulatory and tax regime, where we are, we all know, I mean, doing business, I mean, Indian context, definitely is little, difficult and complex. It is not easy. We have several tax legislation, several, legal legislations, several compliances. If you're operating in the multiple states, the complexity goes up. Fortunately, we have the GST, which has consolidated several, indirect taxes, made, one single, indirect tax, that is GST, which has helped significant way for the businesses in ease of doing business. But in several areas, a lot of improvement is required. So, I mean, that is the complexity we are talking. You have manufacturing, you have services company, multi-locational, multi-state. Then you have manufacturing, you have offices, you have administration office. Sometimes now we have virtual offices. People are working from the residences. We are working from the co-working spaces. I mean, when you work from, I mean, people don't have office. They don't have a permanent office. They only have a seat, variable seat. That's how they are operating. Sometimes even the regulations have not geared up to see what is applicable for them, what is not applicable for them. While the government is trying to, kind of a fast pace bringing the changes, but they are not able to do it. It may not be possible to do, the speed at which business is thinking, entrepreneur is thinking. Regulatory complexity, high compliance burden. I mean, these are some of the data points. I think government has eliminated several legislation, but still, compliance burden is very, very high. And we see an average around 2,500 amendments in a year. Various regulations going through an amendments in a particular area. That's an average. One, you have several legislation. Second, very, very important, I see this is very, very important. The regulators investment into technology, government investment into technology has become many fold, many fold. The reason is very, very simple. One, their ability to monitor things becomes very, very high, so that the wrongdoers can be caught, very, very quickly. Second, cost of compliance, cost of monitoring, cost of regulation becomes very, very less. And obviously, we all know, if something which machine can do, machine does it a lot more perfection and efficiency and lesser cost and quicker time versus a human being doing it, right? So in terms of efficiency also, this becomes very, very useful. Therefore, at least in India, we all know the kind of adoption government is doing, for the technology is concerned. I think, I don't know, any other country can match. Maybe smaller countries like Singapore and all, maybe they may be little advanced, but at least the large countries, I think they're much behind us. It is not the adoption. Government, the regulators have moved to the next level. Integration of several regulators, are talking each other with an APIs, with an API integration. It is not that, somebody has to send an email, they respond, they work on it. Systems are talking seamlessly to see whether everything is right. Earlier they were all in, in isolation. Income tax department was working in isolation, maybe registrar of companies was working in isolation, your GST, your banks and all that. But now everybody is coming on the single platform, and they talk on a real-time basis. Obviously, when they talk real-time basis, you cannot have data, different data sitting in different silos, right? Unless it is correlated, even your reporting will not happen, your intimation will not happen. It has moved to that level. On all regulators are talking. Second, most importantly, for them to monitor, they are making the, you call assessee, you call a business, you call the company, they are making, these people to give as much data as possible, and you decide, are you in compliance or not. That's how the engine is built. That's how the rules are made. Rules engine, but in the technology, that's how it is made. Just to give an example, in the input tax credit for a GST, right? Very, very, very important. Till maybe a few months back or last year, you were, you could put the whatever input tax credit, you thought you have gained, you have paid supplier payment and you have taken that credit. But supplier has not paid tax, but still you could take it because you have paid that money and you have accounted that invoice. But today, what is happening? Unless your supplier pays tax and that is visible in the portal, you are not able to take input credit. This is one example. Second example, in the in the disclosure to the registrar of companies, have you taken any unsecured loan? Have you taken any deposits? Have you have you taken any goods or services from MSMEs? It cannot be yes, it can only be yes or no. If yes, you give the details. Have you complied it? MSME, you are supposed to make the payment in 90 days. If you have not done it, you disclose it. You are supposed to pay interest beyond that. Have you done it? No. Then what's happening, given it is a system driven, while you report the information, you know that you are in breach, you are in non-compliant. System knows. It is not that somebody has to click a button. Automatically, one side you are filing the information, maybe same day or next 2 days or next 1 week, the regulator can click one button and send notices to everybody who is non-compliant. This is the level at which the technology is being used by the regulators. Earlier, if your government or some department was to issue a show cause notice, come back to you, it used to take ages. It used to take months, years. They did not have a wherewithal. It was all manual effort. Today, it's all system driven. This is good. Sometimes, generally it is good, but sometimes it is kind of misused in the transition. We are in a big transition phase. Entire, tax laws and regulatory environment governing businesses. We are going through a big transition. GST kind of looks like it is settled down. Income tax, it is settled down. There was a lot of changes. RBI and the Registrar of Companies, Minister of Corporate Affairs, they brought several changes recently. They're all in the transitionary phase. I think sometimes it appears that our reliance on technology so heavy, which looks like very extreme. I'm also a little worried, today, for every small thing, your Aadhaar KYC is validated, you linked with your Aadhaar KYC is validated, your OTP. Today, what is required, Aadhaar and your mobile number, whether the gentleman exists or not. We have gone to that extreme. Reliance is, very extensive. And, does this harm going forward? Is there a privacy protected? There are several questions. We all understand, that, compliance is good to have and, very important, but for various reasons, some businesses, some companies don't comply, some knowingly, some unknowingly. But important thing is, I think that generation is over. That era is over. You could be non-compliant and you are able to get away for whatever reason. But today it is not possible. It is impossible. Once you are part of the system, you have been tracked. You have been tracked at so micro level that you cannot take chance. If you are a serious, genuine business enterprise, you should fall in line and see that everything is complied, and then only you can survive and grow. You can survive and grow. Otherwise, it's going to be a big problem. And more importantly, it's last 10 to 15 years. Several businesses, either old economy or new economy, businesses are built today also to create a equity value, wealth creation, all of that, right? Situations like that. Traditionally, some businesses, it's a lifestyle business. I am doing, in my own pace. I'm happy to, get on with it. Fine. I will take care of A category compliance, but B and C, I don't need to worry. But if you are very serious about building a very sustainable business, creating wealth, then you have no choice. You have no choice that except to focus on these things. That's a big trend, which did not exist. Now it's very rapidly growing. Even the old economy businesses which are becoming formalized, and we have several examples, like you have Karachi Bakery to the Paradise to several, tea chains, right? Never we thought, 3-5 years back that, chai chains can be branded, but today in some on the highways, I think you don't have any chai shop, without branding. That's a huge shift which has happened. Which will call for, some of these things very. We have listed here several instances where companies have been punished. This could be large companies, some could be mid-sized companies, some could be very small companies. I think the important thing is knowingly. There is an interpretation issue. Knowingly, you are taking a particular position. That is understandable. I know. It's a gray area. I'm taking interpretation, but I'm prepared. If it has to go other way, maybe GST tax is concerned. You are assuming it is 5%, but the department comes back and says 8%. Now you have not collected money from your customer. You are going to have a huge ramification. The responsibility is on you. something like this, can you observe that liability? It is difficult, right? Maybe when you have to be take a conservative approach and go with 8% and comply. Maybe there are certain relatively less magnitude compliances. Maybe there you could take a chance. Last to at least 6 months to 1 year, the Reserve Bank of India and the Register of Companies who monitor, who obviously Register of Companies concerned, all the companies are monitored by the Register of Companies, and LLP are a private limited company. Even small non-compliances, they are putting heavy penalty. While there is a discretionary mechanism, but nobody wanted to take a very pragmatic approach and levy a nominal penalty. The law is providing 1 lakh, therefore I want to charge 50,000. 1 lakh is maximum, but somebody can charge even 500 rupees, 1,000 rupees. Lot of these, sometimes this objectivity is missing. Sometimes it is magnitude is missing, materiality is missing. While something a technical non-compliance versus something where there is an intention to defraud, intention to avoid some taxes, all of that. This distinction is missing sometimes when when the regulators work on it. It is genuinely, sometimes it is possible that a company is not able to comply a particular thing. That is where this materiality has to be tested, objectivity has to be tested. Then you levy a penalty. I mean, companies are if you have to give a fresh issue of shares, there's a lot of process which is involved now. You take a valuation report, you file a particular form now for an increase in authorized capital, then issue a offer document, then you allocate the shares. There are series of events, 3-4 events. You can only do one after other. But regulators are taking their own sweet time to approve certain forms, certain actions. Thereby, the corporates put to a difficulty. Corporate is having to suffer. I mean, undergo non-compliance and suffer penalties. Something like this is happening in some form today. I think which is not good. I mean, even some of the startups we have noticed, right? Last 1 year or so, there are at least 5 to 10 startups who have raised money, $5 million, $10 million. And I mean, there are two kinds. One, technical non-compliances. Second, there appears to be a misrepresentation of revenue and maybe little siphoning of funds. I mean, any criminal activity should not be spared. I mean, they should be penalized. But there are technical non-compliances, I think they have to be seen from a materiality aspect, and they should be, the penal mechanism has to be very swift and very easy, and so that they behave properly going forward. That should be the objective, not that it should be money making. It's they are put to harassment and all. And there is a process for compounding and all of that, which is again becoming a very costly affair. One has to spend a lot of time and effort in getting the compounding done and all of that. I think which is not worth. And another very important dimension nowadays, what is happening is there is a law, there are regulations, but the way the technology is driving certain things are going beyond. Again, we are seeing in the income tax, GST, and the Ministry of Corporate Affairs, while writing the code, while putting the tech platform, they are going beyond what was given in the act and the rules. I think partly, we don't have a decent advocacy mechanism. All of that, maybe for whatever reason, advocacy is happening, either industry bodies or professional bodies. Our role in advocating the good governance, bringing some of these things into the policy makers view and getting it corrected also has come down significantly. I mean, I think the importance for compliance, I think everybody understands. Everybody understands, but the only thing is, people, um, have their own way to deal with it. That's where is the problem. I am a startup. I am an MSME. I don't have enough resources. I will do it once I raise money. Some of these things are costing them big time. I mean, compliances are many ways, right? It's only certain things are information and reporting. Certain things are like you take the Provident Fund ES or a TDS. In these situations, whose money? It is not your money. It is not business's money. It's a third party money. You are in a trust. As a trustee, I mean, we have no business to hold that money. You have collected the GST. It has to be deposited. So one has to, differentiate what is very very material, and if you are acting as a trustee, I think that role has to be discharged properly. But as I was telling you, it was possible maybe 10 years back, 20 years back, maybe to get away. Today, I mean, the context we are in, the way the regulators have geared up with the technology ammunition, I think it is going to be difficult for us to not comply and continuing the business. Consequences are going to be very very severe. So that's where I mean, that's where we came out with a concept called reverse due diligence. I mean, due diligence, everybody understands why and how and when it is done. We'll spend little time. I mean, it's a common, very very commonly used term, due diligence. And when the business undergoes due diligence, I mean, the due diligence could be many ways. Very very frequently. The frequent transactions where due diligence is done, either you are raising money, I mean, one situation. Second, there is an M&A kind of a transaction. The buying company doing a diligence on the target. When the transaction happens, definitely due diligence. One goes to the due diligence. I mean, even in the day-to-day also, obviously, there are several situations. Due diligence happens. Even the matrimonial alliances due diligence. Obviously, this also happens in the businesses. So these are the two important transactions where the due diligence happens very very deeply. I mean, there are again several factors. Goes into the due diligence. It could be business due diligence. That's very very important, right? I mean, whether a business has a sustainability, profitability, market opportunity, whether there is a right team. There are several things goes when one is business due diligence. While business due diligence is done, the other very very important thing is your tax, accounting, and legal and compliance due diligence. To understand, are there any missing pieces? Are there any hidden liabilities? Are there any hidden costs which are not coming? Therefore, diligence is done. Is there a contingent liability? Are there a crystallized liability? So, whatever price I am paying, is it correct? Are there any, uncertainties? Are there any potential obligations and liabilities? One needs to evaluate. Obviously, transaction life cycle goes from identifying target to a negotiations, term sheet, and then due diligence, then the definitive agreements and closing. Typically, this is the transaction cycle for the fundraising and the M&A is concerned. No, this whole presentation is in the context of early stage and growth stage companies, mid-sized companies who are moving from one orbit to the next orbit. Once you have a bandwidth and people, and once you go through once or twice diligence, then then you may not require this kind of an exercise. First time companies getting into this orbit, they are likely to see they will go through some of the either of these transactions, these kind of transactions. They need to prepare for a reverse due diligence. That's what we are saying. Comprehensive evaluation of target companies' financial and operational well-being. That is the purpose of the traditional due diligence. you call it as a rehearsal or a vendor due diligence. Preparing for a real due diligence is called what we are calling as a reverse due diligence. There are several situations where this will be helpful. Investment or fundraising activities, that is I have already covered. The mergers acquisitions I have covered. The next is one is hiring the very very senior level resource. Maybe CXO, CFO, COO, CEO, and they would look at before I get onto this company, how compliant this company is. What is their character in terms of compliance, all of that. I mean, that is happening increasingly. It is not that we choose our employees, they choose us. I mean, it's also happening increasingly. I mean, that is fair. That is fair. Obviously, company wanted to go for the public offerings. Again, the kind of scrutiny one has to go through for a IPO kind of a situation, very very deep. Therefore, the exercise like this will help. And strategic partnership, right? I mean, today we are in the era of, there's no competition, it is only collaboration. The biggest of the rivals are competing in one area while competing in other area. So, I mean, there are several, partnerships and collaborations happening. Obviously, the engagement levels could vary from one to other, but where there are a deep engagement, and partner wanted to ensure that with whom I am dealing, is respectable corporate entity. There is no reputational loss to me. The Tatas wanted to get into a relationship, a strategic partner with it. MSME, they have fantastic product line. They want to partner, but they wanted to definitely ensure that this corporate is their compliance level, their corporate behavior, all are great, above par, above line. That it's happening very big time. There could be foreign collaborations, right? I mean, either we want to go and collaborate in the other markets, or the foreign companies want to collaborate, with us for Indian market. All these situations, diligence happens, and how do we ensure that we overcome? I mean, we satisfy those conditions. I mean, these are the situations where this becomes very very handy. Unlike earlier, how do I get to this information? Whom do I hire? How much time does it take? It was kind of a history. It used to take a lot of time. But today, with the open information, information explosion for any company, significant amount of information one can pull within maybe 24 hours. There are agencies today working with your maybe machine learning and AI, blockchain kind of thing. They can pull the information maybe in less than 24 hours. All the regulators are sharing the APIs. You have your 26 AS. There is another concept called accounts aggregator. Your credit track record, your GST track record, your PF track record, your ESC track record. Everything is available, in the public domain. There are agencies who are there to pull that and give the information without knowing us, without knowing that particular business. All this information can be obtained, and one can review and take a decision. People are coming out with a ranking and review and rating of this. They have credit rating and all that, which is a little more structured, complex, and maybe sometimes little also dated. Maybe they may give some value, but 70-80% now is available, just like that. I mean, when you have to deal with your suppliers, your customers, some companies go through, huge amount of risk, right? I mean, there is a concentration of your customers, 5%, 10%, 20%, 50%. How do I deal with him? How credible that entity is? What is credit worthiness? what has been their behavior in terms of payment. I mean, these are the several situations. I mean, this, it is very very important. I mean, I think some of these I have covered. I mean, the company status as a responsible corporate citizen. I mean, that's more of a philosophical. I mean, business entity wanted to, make money, but you certainly make money, but you have to, follow the rules of the game. That's very important. Worthiness of the deal, transaction, and job opportunity. This is where very, 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 very important. The diligence plays a very, very important role. Say sometimes a smaller non-compliance can lead to a huge amount of effort and cost. Sometimes you may not be able to cure. It's a filing certain form maybe within 30 days, within 60 days, paying 500 rupees. But if you have not done in the right time, if you have to do when the transaction is happening, somebody identified saying that, but you went and started a subsidiary in the US, but you did not report to the Reserve Bank of India, or you got the foreign direct investment into your company, but you did not report. What would happen? There is a provision; it can be cured. There is a process for compounding, but it can take maybe 2 months, 3 months. Your transaction is getting hard. Particularly fundraising transaction, every company or a founder want money yesterday. That's the importance, right? I mean, if there is a delay, I mean, you lose the opportunity, you lose the opportunity income, and the investor also may go back. The transaction takes long time, and there are certain preconditions. Diligence. One identifies these are the 10 things. 5 you can do later, but at least these 5 things needs to be done prior. Unless you cure them, I don't want to come and invest. So the cost of non-compliance, cure in terms of time and effort could be very very expensive, very very expensive. I have seen several transactions, which took maybe more than 6 months. Sometimes, given the cure could not be done, the transactions did not happen. And you don't have control, right? Compounding, maybe RBI has to do, some regulator has to do it. How much ever you say it will take 2 months, 3 months, 6 months. I mean, these are the challenges. The whole idea is the legal and tax and compliance related pieces are evaluated, and your contracts are evaluated, and then find out a gap analysis and see how to fix it, and also rank them ABC and prioritize, and a category which could be in terms of penalties, maybe some of them are imprisonment, or sometimes your contracts, your customer contracts, maybe your employee contracts, maybe the KMP contracts, maybe your warranties, your guarantees, they have not been worded properly. You are exposed to a unlimited liability, right? So when there is an independent check, these things can be fixed before third party comes and tells. I mean, generally this is how the coverage could be. This all depends upon several factors. This all depends upon several factors. What kind of company this is, what kind of context they are in. Is it 3-year-old company, 5-year-old company, 10-year-old company? The kind of operations they have, within India, outside, manufacturing, non-manufacturing, distribution, licensing. I mean, the all depends upon the that particular company complexity involved. One has to put an appropriate diligence framework and undertake the diligence. Yeah, again, I mean, this slide is kind of classifying them in the based on their criticality. Again, this depends upon the each company. For maybe pharma company like FDA remark is very significant. Maybe pollution non-compliance is very significant. This is a business continuity risk, and several things are there. Sometimes so because nobody obviously regulators don't come and check on a regular basis. There may be inspections happening once in a while. There is a random check which is happening once in a while. Proactively, one is able to identify there are no intention issues. Maybe there could be lack of team or lack of supervision. There may be some shortcomings. That can be fixed by doing this exercise. I mean, I think some of this I was covering, and mostly, I mean, the resources may be a challenge, but I think beyond resources, I think the commitment is required. I think once the commitment is there, we need to be on the right side of the law and we should comply. I think all these things can be achieved. As I was telling, maybe it's a reputation once again. Things have changed. We cannot get away. System is not allowing. Maybe the government want to give you a waiver or relaxation, but the system is not allowing. Therefore, we have to fall in line. I mean, there are several examples. There are issues with the cap table. Your stock option plans. Sometimes you don't have the founders agreement. You don't have the your board meeting minutes. So all of these are becoming problem. Sometimes there are disputes. There are disputes among the shareholders. You are inviting a new shareholder, new investor. I mean, for them, capital is very important. We sometimes we promise advisors some shares. Some employees some shares are offered, but there is no documentation. There is no proper compliance. Similarly, under the even the foreign exchange regulations, increasingly there are several instances. The one very regular thing which is happening. The founder promoter goes to US, and he wanted to sign a contract there. He wanted to open a company. He just opens a company, and company comes. He swaps his credit card, and companies formed there. There's no reporting done to RBI in India. That's not allowed. This is a capital account transaction. There is a process one needs to be followed. Similarly, there is a loan which is taken from friends and relatives or from a foreign company in the foreign currency by Indian company. Again, there are regulations around it, which are not complied. The foreign exchange regulations are concerned. I mean, the revenue transactions, revenue account transactions. I mean, absolutely, there is a full autonomy. Capital account transactions, there are certain restrictions. There is a process. Not that you cannot do it, but you follow the process. And a lot of professional services, professional activity, chartered accountant, cost accountant, company secretary, lawyer. There are several services provided by these professionals are also regulated by regulated bodies. The professional bodies. Even these professional bodies have moved forward with the technology. Now the MCA has integrated with the Chartered Accountant Institute database, Company Secretaries Institute database, and then trying to regulate it. Some of the certifications, some of the audits, people used to kind of backdate it. Everybody wakes up in August and September, want to do the audit, complete your board meeting, general meeting, and then reporting to ROC, income tax, and all. People complete in October and then date it maybe August and September, which is not possible in current context. And if one doesn't pay attention, there is a non-compliance. While filing, we are saying to the world that I have not complied, and obviously it will call for the penal actions. I mean, these are the benefits of, reverse due diligence. I mean, one takes up this exercise proactively. Um, I think, I have covered most of them. I mean, identifies potential non-compliance risks and issues, ensures adherence to tax and regulatory requirements, and mitigate the risk of receiving notices, penalties, and legal actions, protects reputation and enhances investor confidence. This is very, very important. Um, Facilitates sustainable growth and longevity of business, enables implementing of corrective systems and processes. I mean, several advantages. I think this is fully, I think, understood, and we all know that it's important. A lot of us also try to do it, but sometimes, lack of ignorance, lack of money, or lack of resources, we tend to ignore. When do we do this reverse due diligence, right? And that's the question we are asking, right? When particularly companies planning to raise money first time in their lifetime, right? Second, they are planning to go for some strategic transaction first time in their lifetime, or planning to go for an IPO. I mean, somebody who is 5-year-old, 10-year-old, but never went through their transaction. Most of these kind of companies also have multiple service providers. I mean, for some activities there is no service provider. There is a single service provider doing all of that activity. He is paid for 2 things. He is not paid for 3 things. Obviously, there is no focus. There is no attention. There is no accountability. Because I mean, nobody hires, I mean, for some of the activities, understood that, he's taking care. I mean, his understanding is, then I'm only taking care of 1, 2, 3, but 4 and 5, the company is taking care. I mean, this is a very, very regular feature. So those kind of companies, I also mentioned, right, while the transaction is happening, if you have to cure the shortcomings, the cost of cure, in terms of time and the cost is very, very significant. Just because, you have shortcomings, if your process of getting money to the company, is delayed by 15 days, 1 month, and 2 months, you see the, ramification. Particularly, you see the maybe a startup, want to raise, say, some money, already raise some money, they have a runway for 2 days, 3 days, 1 month, 2 months kind of thing. And impression you are leaving, right? The kind of impression you are leaving with the investor who is coming on board. Seed stage, it's understandable, but after that, Series A, VC round, now we are seeing, as I was telling, a lot of old economy businesses, pharma, and maybe life sciences, manufacturing. Everybody is going for the fundraising, right? I mean, if the company is 10-year-old, but whatever reason there was no requirement, but now they are thinking, they are looking for a foreign partner who can come as a strategic partner, or dilute money, or go IPO. So therefore, it is very, very evident that if one can take this process proactively, works on it, the amount of saving in terms of time, reputation, and all that is disproportionate. I mean, nothing can match that. I mean, that's the important. I mean, that is what we have covered in this slide. I'm consuming. I mean, I think it is a little bit more emphasized. What I'm saying. The value is humongous. Value is humongous. Sometimes also, the transactions have to be done in a particular structure. Your structure is not ready. People have multiple group entities, loosely, structured, the same promoter having 3 entities doing the same kind of business, or you have a related parties doing the business. You own 100% here. You also have another entity where you have maybe 30-40% other. When the transaction has to happen, I mean, there are some golden rules, right? I mean, people wanted to see that the founder interest is aligned with this company. If he's having multiple, windows or the related party entities, they may not wanted to come and put the money unless you capture value in one entity, create a holdco structure. How can you do this? You cannot do this overnight. It requires time. Maybe exercise like this will help you to understand. I mean, currently I am not ready. These are the 2 things, 5 things, 10 things I need to do. So let me do it and then go to the market and get that right premium. There will also be a premium. If you are a great company with fantastic compliance track record, I think there is definitely a premium. In the listed markets, it is proven. I mean, obviously, Infosys gets a higher PE multiple versus several other IT companies because on their corporate governance there is higher premium. I think that is going to come into the unlisted companies also. Unlisted companies. So that's what we are talking largely. We are talking about like privately held companies. Earlier, there was a I mean kind of a thinking that publicly held companies, their information is in public domain and all of that. But today, even the privately held companies, given the way we are operating, so much of information is available in the public domain. Earlier, the privately limited companies' financials were, not for public information, but they are available for public information today. You don't, that or Companies Act amended that piece. Except accountability to the shareholders and all of that, which is in a private, but maybe governance requirements are obviously lot different for the publicly listed companies versus unlisted. In terms of your information in the public domain is there. This is one of the case study of the transactions we have done. There's a mid-sized IT company, $10 million revenue, and maybe 10-year-old company with 600, 700 people, and having 3 subsidiaries overseas, US, Canada, and UK, and they want us to do this exercise. We did this exercise, and while this is the coverage, in terms of what we have to cover from a, you have immigration, you have employment and law, labor law conformity, you have data security, you have foreign exchange regulations given, you have the subsidiaries and all of that, and you have stock option plan given to the Indian employees and overseas employees, your, transfer pricing, related party. I mean, this is the, coverage. Now, while you have some audits happen here and there, but they take care of one particular area. But the reverse due diligence can be very, very comprehensive. And this is what is the coverage. So the findings are, certain areas, they have been extremely good in terms of their compliance to the taxation, GST, income tax. They have been doing fantastic job. Very, very. Absolutely, there were no delays in compliance or payment of taxes. But certain areas like foreign exchange regulation compliance, or maybe corporate secretarial compliance, there are some shortcomings which are curable, and some of them they don't even know that these needs to be done. If they knew that these are required to be done, they would have got it done. That is what we are having to hear from them. We saw huge value. We were able to add them, and they also thought, this is a very good exercise, which is helping them to, get the reassurance. 8 out of 10, we are going great. These 2 areas, I think we need to gear up and fix it. I think that's what was the message. So I wanted to pause here and wanted to take questions. And then most of my presentation also is done. I wanted to pause here and take questions, and then maybe we could do the conclusion. The intention was not to get into deep dive into provisions or taxes. I'm not a what do you call the expert in several areas. The idea is to give the, sensitize this topic and, drive the importance, and so that, several companies can take these initiatives and, which will help them in big way going forward. Do you have questions?
Yes, sir. I think some questions are posted in the Q&A box. So I'll just read the questions. The one question is there any technological tool addressing KYC, know your compliances with alerts at appropriate time?
I think there are portals and the compliance management technology platforms, but whether they are 100%, I think they are in the process of evolution. Today, maybe they solve almost 70-80%. You give profiling your company details. I think they give you data, what all needs to be complied. I'm sure that 70-80%. It may not be 100%, but 70-80% they're able to help you.
Okay, sir. So there's one question, one member is asking, is the recording will be shared? Yes, we will share the recording link with all the participants and members. The other question is, how can we separate regular due diligence with reverse due diligence?
As I was telling you, right? You are having a due diligence done by a third party when a transaction is happening. That's called a due diligence, right? What is reverse due diligence? You are trying to prepare for a due diligence. That's what is the difference. The process could be almost same, right? It is internal check. You are getting the like a health check. We go every year and get it done. Can we do this once in a while? If somebody was not done it, in last 5-10 years, they should do it, and then update that with every year or every alternate year. That's the difference between the reverse due diligence and due diligence. The components are same, the purpose is same, objectivity is same, but you are doing on your own to understand where you stand, what corrections you should take, you should do. That's the difference.
Okay, sir. The next question is how we can invest in unlisted stocks. I don't know. Is this related to this?
It is not related, but today with several angel networks, you go to any angel network and you have an opportunity to invest in startups.
Okay, sir. I request members and guests to kindly post their question in Q&A or chat box. I think some members have raised their hand, but it's difficult for us to put on the video and audio mode. So it is better if you can post your question in the chat box, please, or the Q&A box. One more. So it is similar to start. So the other question is, so it is similar to start and internal audits.
Internal audit can cover a lot of them. Generally the internal audit covers the financial related transactions. I think that will definitely help. But the coverage could be in the reverse due diligence. It could be 360 degree. Except the business due diligence, everything else gets covered. But definitely internal audits also do help. If there are no internal audits, that also helps significantly.
Okay, sir. The recording, basically recording, we will be sending the recording to the registered email ID, which members have posted while registering for the program. I don't see any other question. If there is any question, please. Yeah, there's another. So basically calling this process as proactive DD instead of reverse DD makes more sense. Yeah, I think that is what we are talking. Yes. Yeah.
It's a good point. Good point. How do we name it also? The important, proactive DD. Yeah, I think one can consider this as a proactive DD.
Another question is due diligence is from external third eye, and reverse due diligence is from internal management.
Yeah, that's correct. Even for doing, reverse due diligence, obviously, within the organization, you may not have these capabilities. I mean, we are talking about mostly, mid-size and growing companies. Several functional areas are outsourced or, thinly manned. Therefore, there is no bandwidth internally. So you need to go to, some specialist or expert and get this done.
Okay, sir. One more question is, who are the best persons, entities to guide foreign exchange transactions, related party transactions, and the compliances? I think Simply Biz is the best. You can try.
We have been doing a lot of work on the foreign exchange regulations. I mean, inbound, outbound investments, kind of, all the transactions, all the transactions in the foreign exchange regulations, we have been advising, we have been taking care. Yeah, I mean, we'll be happy to engage. Yeah.
Yes, sir. That's it. I think these were the questions. No new question. I request all the members, if you have any other question, we will be circulating the video link as well as the we will share the video link, also the detail of the speaker, Raghu sir, with his email ID and his team's contact number. So in case if you want to take any advice, consultancy, or any professional help, kindly contact them directly, or if you like to send me, you can send on my email ID. I'll forward to them. You can take their advice for any of your queries or any problems. I think with this, there's no more question. I'm just checking once again. Yeah. So we are finished with the questions, and we are really thankful to Raghu sir and his whole team.